Earnings. Why good numbers can still drop a stock. Earnings season can feel confusing. A company reports good numbers, and the stock drops. Another company reports messy numbers, and the stock rallies. That feels backwards until you understand one idea. Stocks do not react to the headline number. Stocks react to the number versus expectations. Before earnings, the market already has a story in its head. Analysts have estimates. Investors have expectations. Options traders have implied moves. And the stock price already reflects what people think is likely to happen. So when the report comes out, the question is not, was the quarter good? The real question is, was the quarter better or worse than what the market had already priced in? There are 4 parts to an earnings reaction. First, revenue. Did sales grow faster or slower than expected? Revenue tells you whether demand is strong. Second, earnings per share. Did the company make more profit per share than expected? EPS matters because valuation metrics, like PE, are built on earnings. Third, margins. Did the company become more profitable, or did costs pressure the business? Margins are often where the real story hides. Fourth, guidance. Guidance may matter more than the quarter itself. A company can beat this quarter and still drop if management lowers future expectations. That is why earnings can look good, but the stock falls. The market may say, good quarter, but not good enough. Or, good quarter, but the future looks weaker. Or, good quarter, but the valuation was already too high. Let's walk through 3 scenarios. Scenario 1, beat and raise. The company beats revenue, beats earnings, expands margins, and raises guidance. That is the cleanest earnings setup.
It can tick a stock up because both current results and future expectations improve. Scenario 2, beat but guide down. The company beats the current quarter, but management warns that next quarter will be weaker. That can tick a stock down because the market cares about the future more than the past. Scenario 3, miss but relief rally. The company misses estimates, but the market feared something much worse. If the bad news is less bad than expected, the stock can actually rise. That is why earnings are an expectations game. For compounders, like Microsoft, one earnings report matters, but the long-term thesis matters more. Investors want to know whether cloud growth, margins, recurring revenue, and AI optionality are still intact. For cyclical positions, like memory or commodity-linked stocks, earnings can be more dangerous. The report can reveal where the cycle is turning. That is why StockIQ treats earnings differently for compounders and cyclicals. For a compounder, earnings are a thesis check. For a cyclical, earnings can be an exit-relevant event. Before holding into earnings, ask, what does the market already expect? What would count as a real beat? What would count as a real miss? Is guidance more important than the quarter? And is the valuation leaving room for disappointment? That is the StockIQ earnings framework. Do not ask only whether the company reported good numbers. Ask whether the report changed expectations. Because earnings do not move stocks by themselves. Earnings move stocks when they change the future the market believes in.